Welcome to Mastering MHA MBA. In this lesson, we begin with Chapter 1, the Manager and Management Accounting. This video is based on Managerial Accounting, Making Decisions and Motivating Performance by Srikant M. Datar and Madhav V. Rajan, published by Pearson in 2014. All rights to the original text belong to the authors and publisher. This content is for educational and non-commercial use only. Now let's explore how managerial accounting supports effective decision making and motivates performance inside organizations. Section 1, Financial Accounting versus Management Accounting. The first thing to understand is the difference between financial accounting and management accounting. Financial accounting serves external users such as investors, creditors, and regulators. It follows formal rules like GAAP and focuses on historical data. In contrast, management accounting serves internal users, managers who make day-to-day and strategic decisions. It emphasizes relevance, timeliness, and flexibility instead of compliance. Management accountants provide the information leaders need to plan operations, control performance, and evaluate strategies. Another key distinction is behavioral impact. Financial accounting reports performance. Managerial accounting influences behavior by motivating employees, guiding managers, and shaping organizational culture. This introduces an important concept, cost management, which links information, behavior, and performance improvement. Section 2, Strategic Decisions and the Management Accountant. Next, let's discuss the strategic role of the management accountant. A strategy is a set of long-term actions that guide how a company competes, whether through cost leadership, product differentiation, or innovation. Management accountants help managers implement strategy by providing relevant data on cost, price, quality, and product features. They perform competitive analysis to determine how the organization can achieve and sustain an advantage in the marketplace. In short, managerial accounting isn't just about measuring performance, it's about shaping strategy through insight. Section 3, Value Chain, Supply Chain, and Key Success Factors. Every organization creates value through a sequence of business functions known as the value chain. It includes first research and development R&D, second design of products and processes, third production, fourth marketing, fifth distribution, sixth customer service. Managerial accountants analyze costs, performance, and improvement opportunities at each stage. Closely related is the supply chain, which focuses on the flow of goods, services, and information between suppliers, manufacturers, and customers. Effective value chain and supply chain management are vital for success, and success is measured by five key factors: cost and efficiency, producing at low cost while maintaining quality, ensuring customer satisfaction and continuous improvement, often through total quality management, time speed in new product development and customer response, innovation, offering creative products and solutions, sustainability, achieving financial, social, and environmental balance over the long term. These five factors define performance excellence in modern managerial accounting. Section 4, Decision Making, Planning, Control. Managerial accounting provides structure to decision making through a five-step process. First is identifying the problem and uncertainties. What issue needs solving, and what do we not know yet? Second is obtaining information, collecting relevant data, both quantitative and qualitative. Third is making predictions about the future, forecasting outcomes based on that information. Fourth is making decisions by choosing among alternatives. This is the planning stage. And fifth is implementing the decision, evaluating performance, and learning from results. This is the control stage. Together, these steps create a continuous feedback loop that improves decision quality over time. Section 5, Key Management Accounting Guidelines. Three essential guidelines guide managerial accountants. First is the cost benefit approach. Resources should only be used if the expected benefits exceed the expected costs. This principle underpins all sound management decisions. Second is behavioral and technical considerations. Accounting systems should not only be technically accurate but also designed to encourage positive behavior. Numbers influence actions, so how we measure performance matters. third is different costs for different purposes. The same cost can be interpreted differently depending on the decision context. For example, a cost that's relevant for pricing might not be relevant for production scheduling. Understanding which costs matter in which situation is what makes managerial accounting so powerful. Section 6, Organizational Structure and the Management Accountant. Now let's look at how managerial accounting fits into the organization. Organizations have line positions directly responsible for achieving goals and staff positions, which provide advice and support. Management accountants typically serve in staff roles, supporting line managers by providing analysis and insight. Two key positions are the Chief Financial Officer, CFO, and the Controller. The CFO oversees financial strategy, treasury, risk management, and investor relations. The Controller manages internal accounting systems, budgeting, and reporting. Together, they ensure financial data is accurate, timely, and actionable. Today's management accountants go beyond the numbers. They need skills in analytics, technology, communication, leadership, and ethical judgment. Section 7, Professional Ethics. Finally, let's talk about ethics, the foundation of trust in accounting. The Institute of Management Accountants, IMA, provides a statement of ethical professional practice built on four key principles: competence, maintain expertise, and follow laws and standards; confidentiality, protect sensitive organizational information; integrity, avoid conflicts of interest and refrain from deceptive conduct; credibility, communicate information fairly and objectively. When ethical conflicts arise, the IMA advises discussing the matter with immediate supervisors or using formal conflict resolution processes while upholding confidentiality and integrity. Ethics transform accounting from mere reporting into responsible leadership. Let's recap the essence of this chapter. Managerial accounting is not just about tracking costs, it's about supporting decisions, motivating performance, and building accountability. It connects numbers to strategy, behavior, and ethics. As we move forward in this series, we'll see how tools like cost volume profit analysis, budgeting, and performance metrics expand this foundation. This educational summary is based on Managerial Accounting, Making Decisions and Motivate Performance by Dormanspite and Rajan, 2014, Pearson. All rights to the original text belong to the authors and publisher. Thank you for watching Mastering MHA MBA. Don't forget to like, subscribe, and join us next time for Chapter 2, Cost Concepts and Cost Behavior.